It's a term almost everyone has heard, but it still causes some confusion. Social inflation raises insurance costs for almost everyone. But how?
I'm an actuary by training, so I think about key drivers as contributing to either frequency or severity of losses, or perhaps both. I would point to 4 key drivers of social inflation. The first is the proliferation of class action lawsuits. Sometimes you hear people refer to this as runaway litigation. How often are people filing claims or filing lawsuits? The second one we talk about is growing awards from sympathetic juries. It's talking about how large can these awards go at the end of a trial. A third point is rollback of state-specific tort reforms that were originally intended to control costs. This happened decades ago, state by state, to try to limit how often and how big different lawsuits could be. The fourth and perhaps the most troubling is what we refer to as litigation funding. This is where investors finance lawsuits for either individual plaintiffs or against large companies in return for a share of the settlement.
If you've been in a car wreck, don't wait. Call me now. I've got this.
I hired Mike and his team, and they got me $100,000.
What the IRC data shows is that when you hire an attorney, you actually receive less in terms of an ultimate payout to you, and you get that payment later than if you hadn't engaged with an attorney. A key objective for the insurance industry is to have legislative or judicial requirements for the disclosure of third-party funders being involved in any litigation. A small number of federal judicial districts require it today, but we would like this to be normal operating procedures across the country.
To learn more about social inflation and how III is working to protect consumers from higher insurance costs, follow us on our website and social media.